morning everybody. Thank you for taking the time this morning to allow us to deliver our results presentation to the end of March 2017. So a 6-month presentation. Hopefully you'll see the presentation on your screen. To just give you a summary of our results, we've had an excellent trading performance in the first 6 months of the financial year, and that's been in line with the board's expectations. I suppose the most pleasing thing for me is that the earnings have grown on the back of improved gross margins, which is really reflecting the high quality development pipeline that we have in the business. Excellent cash performance in the period, reflecting our normal working capital profile, where we have majority of our cash is derived during the second half of the year, but we have net cash at the end of March of 11.7 million. Our student accommodation pipeline, which I'll talk to you about a little bit more during the presentation, remains very strong, over 11,000 beds in that pipeline. The growth in our brand Fresh Student Living has been excellent again this financial year, growing from 8,300 beds to 12,000 under management at the moment, and we see some similar growth for the start of the FY17 academic year as well. And again, I'll talk you through some of those projections as we go through the presentation. Encouraging as well is we now do feel that we've got some good momentum in the build to rent sector. A lot of people talking about the build to rent sector, but not a lot of people actually doing anything. But we are seeing investors now actually getting the checkbooks out and making the investments, and we do see some good opportunities in this sector. And again, I'll talk to you around our pipeline on that as we go through the presentation. And I think really to reflect the board's confidence in where the business is going, we've announced an increase in the interim dividend to 2.2 pence per share. That's up 10% on an equivalent 2 pence per share last year, and we would hope and expect to be declaring a similar increase on the final dividend when we announce our 12-month results at the beginning of FY, or the beginning of calendar year 2018. Some of the investment highlights, as I said, the pipeline, over 11,200 beds in the pipeline across 31 sites. And with the announcement of the sale of the portfolio to Europa last week, we've now got 21 of those 31 sites forward sold. 3 more are in legal negotiations to be sold, which gives us great visibility on our business and our core earnings and revenue streams. Deliveries 2017, 18, 19 and 20. We've got 3,400 beds to deliver this summer. All those have been forward sold and are on schedule to be delivered ahead of the start of the academic year. For 2018, we've also now, with the completion of the portfolio last week, forward sold all of those developments, 3,415 beds, ahead of next year's academic year, or the 2018 intake as well. So, as I said, great visibility for where we're going. And in 2019, we've got just over 3,500 beds scheduled for delivery across 9 developments. All those developments have been secured and are in the pipeline. 2,670 have got planning consent, and the other 3 sites we're looking to deliver are progressing through the planning process at the moment, and we're confident that that pipeline will be able to be delivered as well. 2020, we're already starting to fill that pipeline, and we've got 2 developments secured there, just over 1,100 beds. We've got another site that's in legal negotiations, and as always, we've always got a number of additional sites in what we call the hopper as those sites start to come through the development pipeline. So again, more than 3 years visibility on our pipeline out to 2020. On the accommodation management, I talked about that earlier. 8,300 beds last year, 12,000 this year. We're going to be managing just over 16,000 beds from the beginning of this September. And that business is already contracted to be doing just shy of 20,000 beds by 2020. So that's contracts that are already awarded to us. And that excludes the potential of about another 3,000 beds in the Watkin Jones pipeline, because we don't include the Watkin Jones pipeline beds in the fresh numbers until we know exactly what the exit is. And what I mean by that is potentially we could sell assets to an operator that has its own platform, but to do that we carefully consider the benefit of selling with the fresh management opportunity behind it. And then for many of you who've been following us for some time now, you'll know that we've set up the sister company to Fresh Student Living, which is 5-9 Living, and that will concentrate on management of build-to-rent opportunities on behalf of the institutional clients. So a very similar model to the Fresh Student Living model, and we expect to see that gain some momentum in the near future as well. I think many of you that follow us are keen to see how we can see where the build-to-rent pipeline can gather momentum and how that can add to earnings and revenues. And many of you will know that we've completed our first scheme in March this year, which is a development of 322 units for AIG in Leeds. That was a very successful pilot scheme for us, and we've managed to learn a lot from that particular scheme, and I think that gives us a good foundation to now really push on into this sector. We've got 6 developments targeted to deliver in the period FY19 to 21, and we've got a secured pipeline in excess of 500 units there, and we're working on a number of additional opportunities at the moment. And again, I'll give you some more detail around that pipeline as we go through the presentation. Strategy for the business. Well, as you know, the core business is our student accommodation. That will continue to grow in a sustainable way. It's not necessarily about bringing additional bed numbers or additional sites. It's how we can maximise our earnings into the business, and that's what we look to do. The danger of accelerating and doing more opportunities in student accommodation is it dilutes the attractiveness of our business from investors because they want our stock. So I think it's the right way of doing it and targeting an increase in our earnings. If we do more sites in a particular year, we've got to find more sites the year after and year after, so we end up probably not buying as higher quality opportunities and putting ourselves under unnecessary pressure. The build to rent, I think our expansion into that will start to see some good growth in our revenues and earnings in the business, and over time I would like to see that will replicate what we do in student accommodation. So in effect, over time we should be able to double the size of the business. Fresh Student Living, 5-9 Living, they will support the student and build to rent businesses and are the end to our end-to-end solutions. And for many of you will also know that we have a small homes division that completes on about 130 plots per annum, and that business runs itself. It's a good profit centre for the business, and we intend to just keep that going at around 450 plots in the land bank, so a 3-year land bank, so turning that in and driving that business towards our 20% margins that we look to achieve in the student sector. Student accommodation pipeline, this is where we stand at the moment. This is really the detail behind what I've described. As you'll see there, the FY17, FY18 deliveries all forward sold. FY19 deliveries that are forward sold being the dark blue, the light blue being the schemes that are in legal negotiations to sell, and the red being the ones that we need to get planning consent on and sell out to the market. So you'll see there that excellent visibility on where we're doing. And of course, looking at the UK map, you can see where those 31 sites are situated. So again, we're not concentrating on any particular area, but there's a good a mass across the whole of the UK. In terms of student accommodation market, I've looked at this in a number of ways, and around Brexit and the sort of headlines around that. But I think the real headlines are, at the moment we've got over 1.7 million full-time students in the UK. About 1.5 million of those are UK students, and the number of EU students being 82,000, and further afield international students being 156,000. I think probably one of the most compelling stats for us is to compare the number of applicants against the number of places that were offered last September. So the number of applicants in January against the number of places offered in September 16 really give us a true indication of where the sort of the supply and demand dynamics are in the UK higher education sector. And as you can see there, the UK applications are greater than number of places, and in terms of the international students, whether it be EU or non-EU, well ahead of the places that were actually given out in September 17. So again, we're confident that despite the sort of concern around Brexit, that there is sufficient students making applications from abroad to come to the UK. In terms of bed numbers in the UK, 568,000 purpose-built student beds are estimated to be in the UK at the moment, and that caters for about a third of the full-time undergraduate students. About 250,000 of those are operated by the sort of area that we operate in, which is the private sector, with the other circa 300,000 being operated by the universities themselves. But I think, again, one of the most so compelling stats for us is that about 75% of the university-controlled stock was built pre-1999. So it's no longer really fit for purpose. It doesn't meet student expectations. It's not en suite. The bedrooms are a lot smaller. So we think there continues to be a great opportunity to continue the expansion into the UK purpose-built student accommodation market. I think it feels as well in the UK as a whole that student accommodation, thousands of beds are being delivered per annum. But I think the real numbers, if you look at the stat I've got in the presentation there, is just over 26,000 beds are added to the market in September 16, and previous years were less than that. So, you know, there's still a long way to go to get towards even 50% of undergraduates living in purpose-built student accommodation. And what we're still seeing is the flight to improved quality continues. And when you see what we give, it is effectively a house of multiple occupation, but on a more managed basis with a 24-hour, 7-day-a-week on-site management. So everything works. It's safe, it's secure, high-speed internet. Students have the best of everything. And local authorities see student accommodation now as a solution to a lot of their housing problems. They can see that purpose-built student accommodation can see students moving away from houses of multiple occupation into well-managed stock, which means the theory being that those houses should be released back to the local communities and sort of have an effect on local house prices and rebuild those communities. In terms of investment demand, the investment demand in the last 9 months has been stronger than ever that I can remember, and we're very confident in where that's continuing to go. Purpose-built student accommodation is seen as a mature asset now. It produces stable income. Last year, about 3.2 billion pounds of the stock was traded. And this year we expect similar amounts of investment stock to be traded as well. We're seeing, as was shown in the portfolio sale we did last week, that these investors are willing to pay premiums for larger portfolios, which is why we took the decision to bulk together those 6 sites, which really gave us a good opportunity to quickly get full visibility on our FY18 numbers as well as our FY17 numbers. Rental growth continues to run ahead of RPI. On average, was about 3.5% last year. And that again gives investors great confidence that they can continue to invest in purpose-built student accommodation. Direct let yields, we're seeing a sharpening of those, and those are typically 4.5% for prime central London and out to sort of 6% in secondary regional areas. But there is demand in all areas, and some investors have different investment criteria. So again, a wide base of investors that we work with. And I've included there in the slide Our current development partners, so some big names in there, some key institutions. And to become a development partner of their choice, you have to be seen as being what they class as a tier 1 development partner and a tier 1 contractor and a tier 1 manager. And we're able to tick all those boxes for those institutions, and they have belief in what we do, and that drives our investment demand. Fresh student living, as I said, I think we've covered most of those slides. Just over 12,000 beds under management at the moment, and another 4,400 beds under mobilisation, ready for this September, operating in 24 towns and cities across the UK. The build to rent pipeline, as you'll see there from the slides I put in there, the product is very, very similar to what we've been doing in purpose-built student accommodation for the last 15 years. We've delivered over 98 schemes, over 32,000 beds. So the transfer of our skills into build to rent are quite straightforward. At the moment, we've got over 1,200 beds in our pipeline, and 6 of those developments are forecast to be delivered in the period 19 to 21. The completion dates on the build to rent are not as fixed as purpose-built student accommodation, so we see there being some opportunities in our business to sort of deliver these schemes at the less demanded areas in our financial year. So more delivery round about January to March. As you can see there, we've got 6 schemes, 3 that we've secured and 3 that we're under negotiation to secure, and we would hope to secure those in the near future. How we sell those schemes into the market, I think that the strategy there is we need to have a small portfolio of schemes that we can take out, which will drive the demand from the investors. So we need, in my view, sort of 700 to 600 units, 3 sites to sort of encourage that investment into the build to rent. There's a weight of cash there to come, but smaller schemes are not going to get that investment appetite initially, in my view, from some of the institutions. So we need to bring them something that will give them a return, and it's all about scale. Like it was in the student sector, it's how you get that scale into the institutions as quickly as possible. In terms of the build to rent market, really some really strong, compelling stats here. And again, consumer demand, investment case, and our opportunity. I think if you look at the consumer demand, general population is growing. We've got over 65 million people in the UK at the moment, and that's forecast to grow to 71 million by 2030. It's well documented that we're not supplying enough homes in the UK on an annual basis, and it's estimated that 250,000 homes are required annually, with over only 180,000 homes being delivered during 2016. And it's estimated that the current UK housing deficit is estimated at about 1.4 million homes. I think as well that renting a property now is more socially acceptable than it may have been a generation or a decade back. And what we're seeing now is rented housing stock accounts for about 18% of the proportion of housing stock in the UK. And we see that growth will continue as it gets support from government, the population growth, and probably most compelling is the stretched affordability metrics for many people. But also a transient population where we see people not sure where they're going to go, where they're going to live, and are far happier to rent. That change in attitude has been seen in the States, where about 29% of the US population rent their properties. In the UK, it's about 15%. And again, we don't believe that consumers are going to come out of modern purpose-built student accommodation and then look for anything different or an inferior product to what they've lived in. So build to rent will cater for those consumers, and potentially that's over 500,000 students per annum that will leave higher education sector. So, you know, a huge market just on those students graduating on an annual basis. In terms of the investment case, increasing institutional demand, and we're seeing a lot of that investment demand coming from the States, and I think that demonstrates the success of the sector in the US. Why not repeat it in the UK? Knight Frank have estimated that 25 billion has been invested in build to rent to date, and that's forecast to grow to about 70 billion by 2022. So again, huge numbers, and I think we're in a good place to capitalise on that. Stable rental growth, annual rental growth, gives us a great opportunity, give those investors opportunity. But where do we see our opportunity? Our opportunity really is where we can leverage our significant experience in delivering multi-occupancy buildings into the built-to-rent sector. We've already got the relationships with the institutions that are looking to invest in this sector. Very similar, if not the same model dynamics to what we enjoy in purpose-built student accommodation, where we acquire the opportunities and forward sell them. And as I said earlier, we're recognised as the tier 1 developer and contractor, so ticks the risk profiles of a lot of these institutions. We're already managing over 16,000 student beds in the UK, so to add a few more beds in the build-to-rent sector will enhance that opportunity as well. And the year-round deliveries that I talked about, that improves our resource and supply chain efficiencies as well. So again, great opportunities on that. In terms of the group financials, the headline numbers, our revenues increased or decreased. There was a slight decrease in our revenues, but that was much around timing of some of the forward sale developments. And as you'll see now, with the forward sale of the portfolio to Europa, we would expect that to be caught up by our year-end numbers. Strong profit growth in the half year, profit up by 23.8% to 29.1 million. So very, very strong there. Gross margin of 21.8%, and I think that's particularly pleasing for me, because we target and appraise our schemes on achieving 20%. So to get over that 20% hurdle is a great opportunity for us. Adjusted EBITDA up to 21.9 million, and basic EPS, adjusted basic EPS of 6.7 pence against the H1 2016 of 5.2 pence. We've talked about the progressive dividend policy. We've increased it by 10% this year, and we expect to look to push that forward as we go into future years as well. Net cash at the end of the year, 11.7 million, reflecting our normal seasonal working capital. The income statement is there, but probably the easiest slide to talk around is the segmental summary. You'll see there that the majority of our revenues and earnings come from our student accommodation developments. That's £237 million of the revenue, gross margin of 48.6 million. And again, those significant increases in margin reflect the location and quality of the development pipeline we've got coming forward, and being able to sell those schemes to an increasing number of institutions. The accommodation management, you can see there, we've got H1 is the full 6 months, whereas H1 16 was just a month after we acquired Fresh at the end of February. And we see that the revenues for Fresh are up 36% to 3 million, and the gross margin is 63.2%. When we see the growth in the bed numbers, we'd expect similar gross margins as we go forward, and that business has been tasked with accelerating the potential of having additional beds under management, and I think there are some good opportunities there. The residential development, you'll see an increase in the number, or increase in the margin, and that's the way we push it forward. Small part of the business, but an important part of the business as we look to continue to develop out the land bank and turn that tied up land bank into cash. A couple of numbers that I'd just like to highlight on the statement of financial position, probably around the inventory and WIP, a higher number there than H1 16, but very similar number to September 16. And again, with the sale of the portfolio to Generation Estates, Europa Generation Estates, we'll see that reduce quite quickly. Cash at bank, 25.1 million. And again, we'd expect to see that get back up to the numbers that we would expect, or similar numbers at the end of September this year. We're always looking, our target is to grow our EBITDA, grow our cash by our EBITDA, less our tax, less our dividend on an annual basis. Cash flows reflect pretty much what normal working cycle. We do spend cash in the first 6 months of the year as we get the sites onto, get the developments onto site, and we look to forward sell those developments. And then the cash profile is pretty much like a hockey stick, and expect to see, as I said earlier, we generate cash in the second half of the year. So hopefully that gives you a good oversight. Most of you will know the model. I can come back to that on any questions if anybody has any. But hopefully that gives you a good oversight as to what we're about and where the business is heading.
Thank you very much, Mark. Very helpful. Well, we've had a few questions in, so we'll start making our way through them. Having a look over the next 5 years, obviously you've been doing very well in the recent years. What do you consider to be your sustainable growth rate, and do you typically follow the economic UK cycle?
Yeah, I think our growth rate is what I'm very clear about is I want to grow our core student business in a sustainable way, so see some increases in the revenues and earnings on that on an annual basis. But I think that we've got the opportunity to replicate what we do in student in the build to rent. So over time I'd like to see that we have 2 business streams of equal size and contribution to the group. In terms of the economic cycle, I think we're quite insulated from the economic cycle and in better asset classes than maybe other areas. And what we tend to find is the sectors we're in are quite counter-cyclical. So if there is a slowdown in the economy, we see more people going back to university, so the more demand for our product. And I think the fact about build to rent, I think it's going to be the only opportunity for people to rent their properties. Okay,
well let's move on to build to rent then. You just mentioned there that you see it becoming 2 businesses of equal size. Let's look, say, to the next 3 years then. Do you expect it to be a 50-50 split in that time period?
No, I think that would be too ambitious. I think there's still a lot to be proven in the market. I think the institutions recognise the opportunity, but I think what we've got to be careful is that we don't sell too many assets too soon into the market. And when these schemes are going to take 2 years at least to deliver, what we want to make sure is that we release the schemes into the market on a sustainable way as well, so we maximise our opportunities. We need to grow our teams internally to make sure that we've got the resource to deliver, and I think more realistic is around about 7 years.
Okay, thank you. If the opportunity in the buy-to-rent market is as strong as you seem to indicate, does that mean that you're seeing more competition for land as others try to take advantage of the opportunity as well?
I think with land, I think the opportunities that we're looking for, if you just take our student opportunities, we're looking to acquire or deliver 10 to 12 sites per annum. If we're looking to deliver 10 to 12 sites over time in the build-to-rent sector, even if we're looking to, so that's on a sort of simplistic basis acquiring 20 sites per annum. It's not a huge number of sites to acquire over the UK. So I think those opportunities are out there. We rarely buy sites that have got for sale signs in the ground. We pride ourselves, and I think we have expertise in finding opportunities by walking the streets, identifying good opportunities and building our pipeline on that basis. So I think by having all the disciplines in-house as well, from acquiring sites, doing our own construction work, we can tie down very, very quickly, and we can move very, very quickly, and we've got a great reputation for delivering and acquiring sites when we say we're going to acquire them, and it gives sellers, vendors, confidence that we will deliver, and I think that's one of our great opportunities.
Okay. Well, let's focus then on location of sites. At the moment, the buy-to-let seems to have seen a strong bias in the southeast. Is this because you're finding where the institutional demand for the buy-to-rent market lies, or is this because this is where you have the best relationships?
I think it's a case of where the initial investor appetite is, because I think if we're in the southeast or London, you know, people understand it a lot more. There's a greater population to sell your product to, and I think it'll evolve where if we go out into more secondary towns and locations, which I do believe it will be there in time. It's proving the model. It's demonstrating to the tenants that they're getting more for their money. If we look back as to how we got into student accommodation, I can remember very early days as we got into those developments where, you know, the challenge and the questions raised, well, why will a student pay you £100 a week to live in a purpose-built student accommodation when they can rent a room in a house for £80 a week? And it was never really understood. But it is this flight to quality, and I see that those will be the similar dynamics that we've got in build to rent as we go forward.
Okay, thank you, that's helpful. Moving on to visibility, you touched on the fact that you've got sort of 1,000 bed visibility already for 2020. Sounds like a very strong number, it's fantastically encouraging. This 3-year visibility, is that something that you've always had historically, or is this perhaps more illustrative of macro factors giving you strong tailwinds at this point in time?
No, I think we see it as, I mean, if you take it as a like a house builder would do, that they keep their land bank topped up and they maintain their land bank so they know which way they're going. I think that's how we operate. I think it's taken time to get into that position, but it's a good focus, it's a good measure of where we're going, and it's making sure that, you know, there are no surprises on the horizon for the business.
Okay. Perhaps a question for Phil, but in 2013, Lloyds Bank, they withdraw their funding for Watkin Jones, and can you explain why?
No, that's not quite correct.
No, I don't think.
What we had was our facilities with Lloyds Bank expired at the end of 2011. At the time we had debt, when we were coming up to that renewal, we had debt of about 100 million with Lloyds Banking Group. They said they didn't want to renew. We recognised that we didn't really want to be geared up at that sort of level. So that's where we actually developed the forward sale model with some of the private equity houses that we sold stock to. And then we refinanced it in 2011 with HSBC. What that meant is we went through that refinance process, and we refinanced with HSBC at about 23 million. So we'd paid off 77 million over a short period of time. What that meant is it starved us of cash as we were paying down the debt, which didn't allow us to buy new sites. And those new sites are what were delivered in 2013. So that's where you see in the numbers, the historic numbers, 2013, you see the drop in earnings because we didn't have the development pipeline coming through. And then that's why you also see the significant growth after that, because we were able then to have the facilities to grow, buy the opportunities to grow the business going forward, and that's where we operate on the model that we do now. So historic stuff, and in some ways set us on the path we're on today.
Fantastic. Well, on that note, obviously congratulations on the forward sale of Europa. Can you tell us a bit more on how you trade off the comfort of having all imminent completion sold versus a desire to maximise gross value?
This is always a challenge, and it's a balance, and you know, we need to, you know, this business that we operate is we're in this business to generate the cash, and I suppose that's a reflection of where we were 2010-11 as we were refinancing, and we like as a business to have cash on the balance sheet. We wouldn't want to forward sell all our schemes as a portfolio, so it's about a balance, and it's the cash that we generate from the forward sales allows us to buy new sites for the future and maintain the pipeline. if we start to hold assets, I think we also become a competitor to some of our clients, and I think that is probably a disadvantage. By being open and transparent with our clients, they see exactly what we've got, and it sort of commands competitive tension as well through the institutions, because it's all about scale to these institutions. They see what our pipeline is, they want a piece of our pipeline, and I do believe that, you know, we get good value and, you know, potentially enhanced, and we sell stock at potentially enhanced yields on that basis. So it's the right model for us, and it's one we shall continue to do.